In this latest installment of Trading Exits, I want to cover another simple way to place targets to exit your trades in profit. Now, we all know that markets travel in waves called impulsive and corrective waves. Impulse moves are with the trend, and the corrective move is counter to the trend and is also called a pullback. Generally, I prefer to enter every trade during the corrective wave in the direction of the overall trend or the impulsive wave. It's a bit of an art form as you are entering the trade when the market has yet to confirm a return to an impulse move. The problem is that when you wait for too much confirmation, the trade is well underway and you now have a larger stop, which equals a lower position size. The good thing is that we can use the prior impulse move to estimate how far the market may travel before entering another corrective wave. We call this a measured move. And we can say that's actually A to B equals C to D, which simply means that one wave will equal the other. So let's use the same trade that we've been using in all of these trading exit articles to keep things fair and compare apples to apples. Now here you can see I have drawn a trend line from what I determined to be the start of the impulse leg or the A to B move, which occurs before the corrective move. The line is then projected from the lowest low of the corrective move and projected upwards in the direction of the probable impulsive wave. As you can see, price rallies fairly strong right up into the target, which is 180 pips away from my trade entry. Price exceeds the projection by about 50 pips and then reversed 170 pips to the downside. Now let's finish off this chart series by measuring the previous impulse leg that took us to the trade target and project that from the 170 pip corrective low. The measured impulse leg was 272 pips, and as you can see, price busted through that target and eventually traveled 70 pips beyond and then reversed. So let's not stop here though. How about we measure the reversal leg from the last chart and project from a corrective area that sets up a short trade. As you can see, the A to B move measures to the pip, the end of the C to D move at 162 pips. Now I don't want you to think that this is foolproof, as this is going to show in this chart. I took the previous A, B, C, D and I made it one large impulse move and projected that from the larger corrective move. Price fell short about 40 pips, but it still served up about 220 pips before price action was giving signs of an issue with the move. Now this is just another tool that you can experiment with to ensure that you're able to have an objective target for any trade that you enter during the corrective phase. With a sharp eye and experience with price action, you may be able to add some discretion and then bank the majority of the move before the retrace begins.